The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
FOMO sets in and the market takes off. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Scarlett Fu. We're kicking off to the closing bell here in the U.S. The path of least resistance is higher right now.
Absolutely. I got my 6144 hat.
Any minute now or any day now. Let's take a look at where we stand. We're not there yet at 6144, but the S&P 500, again, revisiting those highs from February. And at its high was about 5 points shy of that 6144 level. The two-year yield, you can see the yield coming down almost 7 basis points, 3.71%. Shorter dated treasuries are extending their rally. A batch of data today really fueling bets that the Fed may cut rates 3 times this year. The Bloomberg Dollar Index, of course, that's not good news for the dollar. It is down by more than half of 1%. It's already at a 3-year low. And NYMEX crude having a fairly moderate day given the recent whipsaw action that we've seen there, settling at around $65 a barrel.
All right, let's go back to stocks here because it's kind of curious to see such a rally on a day where we actually got some pretty interesting economic data, downward revisions in consumer spending, upward trend lines for continuing jobless claims, and the widening of that trade deficit. But maybe it's not so curious when you consider the equilibrium with the other data out there, which is showing more strength, which is giving investors and the Fed alike a modicum of confidence for continued economic stability.
One of the reasons maybe why the market has been so resilient is because the Fed remains in pause mode. So I'm not sure that the market's rally is a function of believing the Fed is going to imminently step in and cut rates. I think it's confidence in the Fed, at least at this point, sort of digging their heels in, suggesting that neither side of their dual mandate is suggestive of much easier policy.
A great explanation there and a bit of a contrarian one. Now, to be sure, the record rally is not without its detractors. While the S&P is a smidge from reclaiming that all-time high, only 2 of the 11 S&P sectors, industrials and technology, are at records themselves. Furthermore, you have 50% of the index's point move since that April low, attributable to just 10 stocks, including NVIDIA, Microsoft, JP Morgan, and Netflix. And that's not all. The percentage of S&P members trading above their 200-day moving average, that's actually gone down since mid-May, and an equal-weighted version of the S&P is still almost 4% away from getting back to that peak from November. Dan Wojtowski, technical strategist over at Janney Montgomery Scott, I thought put it best, Scarlett, saying if breadth does not follow the breakouts in the S&P and NASDAQ, we should maybe be on the watch for a correction?
Well, I mean, certainly this binary outcome is something that we've all been on the watch out for. And that's in part because the stock market's price action doesn't really necessarily align with the release of economic data. Take a look at the blue line. That is the S&P 500 here. The white line is the Economic Surprise Index. And when this line goes down, as it has been since late May here, that means data releases are trailing the consensus estimate from economists. On the whole, economic data have been coming in softer than expected. The S&P 500, meantime, you can see, has been building on its gains and, of course, reclaiming a 4-month high not so long ago and on track for a new record high as well. Romaine?
All right, kicking us off to the close is Jitania Kandhari, Deputy CIO of the Solutions and Multi-Asset Group at Morgan Stanley Investment Management. And Jitania, it's been a phenomenal run for stocks. I don't want to quibble about whether it was justified, but I do want to know if you think there is actually more room to run overall.
I think it's interesting that the difference between the hard data and the soft data, that disconnect has been the highest since 1970. So I think there can be a chance where some of the hard data converges and we see some more slowdown coming. There was a lot of front loading in ports, etc., because of the tariffs. We have July 9th coming. So I think one needs to be cautious and discerning in terms of what pockets of market one needs to get into. Before we had the correction earlier this year, we had a monster rally that was driven almost entirely by AI and the AI ecosystem, if you will. It looks like the resumption of this rally is also based on the structural idea that AI is here to stay, and more importantly, it is much broader than just buying chips from NVIDIA, that there is an investable universe of AI companies out there, and I wonder if you find that. Absolutely. Just like the electricity and internet is everywhere, AI is going to be everywhere, and that's the quest to find what is the next leg of that investment story. So I think one needs to look at it both in the business-to-business space and the business-to-consumer space. In the business-to-business, a lot of the enterprise companies that are offering horizontal solutions look great. In the consumer space, you have a lot of verticals that are using AI to harness their offerings and grow their TAM in music, in e-commerce, in different platforms, even on the factory floor with industrial software. So we're looking at this theme beyond just tech in the actual industry verticals across not just the US, but even in the international space that look really compelling at this stage. And one last thing I'd say, even in emerging markets, you can leapfrog the innovation, just like you never had banks in India, but you have a mobile phone. You could have native AI solutions and equivalents that can be a good productivity and market driver.
That's a good point.
How do you determine the application of that technology, though, if not for the material benefits on the revenue and bottom line? Because if companies are applying that AI, that technology to their operations, do you rely on company management articulating that, or do you look for more concrete signs?
Yeah, I think at the outset, incumbency is an advantage, right? So if you're an incumbent in a vertical, for example, in, say, an industrial company that does a lot of the industrial electrification, capital goods kind of in that space, and you're able to deploy AI to enhance your costs, cost efficiencies, which improves margins, or even expand your market by offering new innovations and applications based on that new AI application. So I think it's looking at the incumbent primarily as a starting point in different industry segments, and then really understanding at a micro level what they are saying and how they are really harnessing this.
So this idea of being more cautious and discerning about how the AI narrative applies to other parts of the market, how does that fit in with the overall macro environment, especially when it comes to rates, with so many people looking for rate cuts later on this year? Put that together.
Yeah, so I think the one interesting unknown is the productivity enhancement that the AI, all-encompassing AI will bring to the world, right? Both in the US and even outside. So if there is that productivity, which generally comes with a lag in past technology revolutions, it seems that it may come earlier because AI adoption has been much faster than the internet or the mobile adoption, etc. So that could be an important driver for costs, for interest rates, and therefore I'm not a strong believer of rising rates, because I do also believe that above 4.5% rates, which at inflation of 2 and a real rate of 2.5, at this level of debt in the global economy, that can be really, really constraining. So I do think that the overall impact of all of this on the rate situation is more down than up.
More down than up, but it also gets to the idea of where the global economy goes. And I know a lot of people think that, at least for now, we have some degree of stability that might actually keep the Fed at bay, whether they're going to raise or cut. Does that even matter, though? I mean, we've had this rally in absence to a certain degree of Fed support, I mean, at least of easier support. So why would we need it, say, I don't know, in 3 or 4 months?
I don't think really what really matters is not the level of rates, but it's the change and the change relative to expectations, which feeds into markets. So I think based on where we are, I think that expectation in terms of the cuts that are being priced in and what could potentially happen seem like the risk reward is balanced. So again, you know, when there's a big disconnect between what the market's expecting and the actual outcome on rates, that's when the bigger moves in the market happen.
All right, Jitania, always a great conversation. Jitania Kandhari, Deputy CIO of the Solutions and Multi-Asset Group at Morgan Stanley Investment Management, kicking us off to the close on what could be a record day for the S&P 500. When we come back, though, we are going to talk Hollywood and talk to one of the greatest documentary filmmakers of all time, R.J. Cutler. We're going to talk about Olivia Newton-John. We're going to talk about Martha Stewart and esports. Trust me, Scarlett, it'll all connect.
I can't wait. All right, let's stay with the movie magic, because we're going to be discussing Apple's test drive onto the big screen after the IMAX release of its new F1 movie with IMAX's CEO Richard Gelfond.
We're also on watch for Nike earnings, and well, that's an excuse to talk to an icon in the sneaker industry. Dwayne Edwards going to be joining us a little bit later in the program. Stick with us. This is The Close on Bloomberg.
For today's Stock of the Hour, it's a twofer. Cloud company CoreWeave reportedly has its sights on buying blockchain and AI infrastructure player Core Scientific again. Core Scientific shares up right now about 32% after the Wall Street Journal's report. The two companies have been working together since CoreWeave first approached Core Scientific last year for a deal that was turned down. Let's bring in Anurag Rana, senior tech analyst over at Bloomberg Intelligence. Anurag, CoreWeave made a bid last year for $5.75 a share. It was rejected as too low, and now Core Scientific is worth more than double that price. How much more is it willing to pay up here for a piece of Core Scientific?
I think if you see over the last 12 months, there has been a marked change in the AI infrastructure environment. When we saw back in January, everything fell apart with DeepSeek. People were extremely pessimistic about it. And then even when the CoreWeave IPO came out, it came out like well below where it's trading right now. I think it was roughly around $40 or so. But I would say in the last 2 months, the sentiment has changed completely. There has been a complete revival in this trade. On top of that, CoreWeave has gotten enough orders from all kind of cloud providers right now. So I think this is just their way of making sure that they can get enough capacity to fulfill that demand. And frankly speaking, given the enterprise value of CoreWeave, even if they pay a little bit extra, I don't think it matters.
I am curious about just the overall infrastructure build out and the idea of software companies that maybe were reliant on leasing out their own servers and other sort of data centers, whether we are going to see much more of a move to actually claim ownership of that.
See, Microsoft has said, very clearly that they're going to do both. They're going to build, but as well as they're going to lease. It depends on what kind of a workload it is, how much down the future you need this. And CoreWeave is providing a good service in between, because for those people who don't want to build it themselves, they want to just rent it out, these guys are creating a large infrastructure for that. So I think there's a space or a place for all the players in the market, whether it's Microsoft, AWS, or for that matter, CoreWeave.
So the two do have an existing partnership. They have a series of, I believe, 12-year contracts. How does CoreWeave convince Core Scientific that an outright acquisition would be in its best interests?
I think, one of the things you have to notice, if you're a small player, you require a lot of CapEx to grow. And in a good environment, maybe the CapEx was available and investors were willing to put a lot of money. But we also saw even CoreWeave had a very hard time during their IPO. So that may be, a reason behind other smaller players to say, we will look at consolidation in the industry. There will be a roll-up, and somebody like a CoreWeave would be involved in that roll-up.
All right, Anurag, always Rana, senior technology analyst over at Bloomberg Intelligence. A closer look there. You see shares of Core Scientific, which have been halted and then restarted, now up about 33%. CoreWeave only fractionally lower on the day. Some modest concerns about costs, but as Anurag just said there, Scarlett, he thinks that even at a premium valuation here, that most investors will probably take it in stride.
It feels like everyone's trying to get something in before July 9th comes around, when everything might go topsy-turvy again because the pause on the trade tariffs expire.
Yeah, maybe. That's a whole other thing here. I do just want to bring some attention to our viewers, and I don't know if we can get Uber shares up on the screen, but we're actually starting to see shares of Uber spike higher here, now up about 3%. This on the back of a New York Times story that apparently says that Travis Kalanick, to a certain extent, might actually be back in the fold. According to the New York Times, Scarlett, they're saying that the ride-hailing company is in talks to help Travis Kalanick invest in an autonomous vehicle company called Pony AI. We talked a lot about this company. It's a Chinese company.
Yeah.
It's a Chinese company. This would be a deal for the U.S. arm of that company. And it really just gets to this idea of the intense competition right now in the self-driving ride-hailing space, obviously, with Waymo making a lot of strides, and of course Tesla trying to make its stamp in the space as well. Yeah, this feels like a bit of a soap opera here, because Travis Kalanick was forced out in 2017, and his ties to the company, as it stands with operations, is pretty much clear, but in that they were cut.
But now you have him possibly being a partner in some way.
Yeah, we should point out shares of Pony, the ADRs, excuse me, of Pony AI here in the U.S. They're up about 16% right now. Ticker PONY, UBER. Keep an eye on that, and we'll bring you any updates as soon as we get them. When we come back, a broader conversation about the tech space with Dan Ives. This is Bloomberg. All right, time now for our top calls. Big movers on the back of analyst recommendations, and we start off with Unity Software. Bank of America reinstating coverage of the software graphics company with the underperform, the only sell equivalent among the 22 major sell-side analysts covering the stock. The price target set at a street low, $15 a share, with BofA saying Unity's content consumption strategy for its gaming engine is lagging. You see those shares down 3.5% on the day, on pace for their first monthly drop since March. Next up, Microsoft. Morgan Stanley raising its price target to $530 from $482 and maintaining an overweight rating. The analyst sees yields on Microsoft's investments in generative AI becoming increasingly apparent. Those shares on a 40% run from the April lows to a record high. And last up, Apple. JP Morgan cutting its price target to $230 from $240. The analyst saying demand for the next iPhone could actually be hurt by macro uncertainty as well as tariff headwinds that will lead to higher price tags for the devices. Those shares sitting out of today's rally down about 0.3%, and those are some of our top calls. Despite the softness that you're seeing in Apple, most of the tech space is rallying hard. In fact, a big part of the rally that we've seen off those April lows are because of big tech. Dan Ives covers that space better than anyone else as global head of technology research at Wedbush Securities. And Dan, I guess the big question everybody wants to know is how much life is there in this rally?
I think this is just starting in terms of this next stage of the AI revolution. And I think as we go into the software phase, you see on the consumer side when it comes to AI, I believe this is still bottom of the first, top of the second inning. And that's why NVIDIA, $4 trillion, ultimately $5 trillion. Microsoft, we think on the road to 4 and then 5 trillion. It's our view, this tech bull market, get the popcorn out, I think it's going to be a very strong second half.
There's only been a lot of talk about the big structural changes that AI is bringing, not only to the companies themselves, but potentially to the economy and to the markets. You're also seeing sort of a similar sort of run for the gold going on right now in the autonomous vehicle space. And there were just some headlines a while ago out of the New York Times that Uber has actually tapped its former CEO, its co-founder, Travis Kalanick, to potentially fund a deal to buy a company called Pony AI, which makes autonomous vehicles, the U.S. arm of Pony AI, I should say, that helps to make autonomous vehicles. I do want to get your thoughts on that deal and about the amount of money and effort that these companies are spending to get ahead in this self-driving ride-hailing space.
Look, that would be the smart move for Dara, and I think there could be more behind it. Because when you look at the next phase, when it goes to physical AI, it's about autonomous. And Uber, when you look at Tesla shot across the bow, everything we saw in Austin, that's now started to play there. Uber needs to definitely focus on partnerships and expanding their repertoire when it comes to autonomous. This would be a smart strategic move, aggressive if they did it.
How important is that first mover advantage that Tesla and that Waymo currently enjoy?
Yeah, look, first mover advantage is important in terms of Waymo, but the reality is those are $230,000 cars in 4 to 5 cities. It's all about scale. That's what Tesla's going after. And that's why Uber, they can't just sit there and Darren knows this on the treadmill. They're going to have to aggressively focus on their fleet and what they could do when it comes to autonomous. And I think that's going to be the next chapter when it comes to AI, but it speaks broadly to our view of tech. From robotics to autonomous to enterprise to consumer AI, across the board, I mean, this is, I believe it's a golden age for tech.
So when it comes to funding something like this, how much are investors going to be comfortable with that without seeing a return on investment in the immediate near term? Because that was a question when it came to building up the AI data centers and the AI capabilities. And at some point, investors were willing to give the companies the benefit of doubt until it became clear that the spending wasn't resulting in anything tangible.
Yeah, and then obviously you start to see it come through. And that's why the last thing investors want to see, you don't want to see them on the outside looking in. I think that's why Apple's underperformed, right? Because the reality is when we were at WWDC, the AI strategy, right, it was kind of a shrug the shoulders. Investors right now know this is a Game of Thrones arms race that's going on when it comes to AI. Stronger going to get stronger when it comes to tech. But that's why look what's happened with Nadella and Redmond. They're just getting stronger and stronger when it comes to AI because they recognize where the next steps are. That's look at names like Palantir, the Messi of AI. It shows this is not stopping. Tech needs to continue to spend.
I am curious, Dan, how you value these companies. I know there's been a lot of talk about how traditional valuation metrics and multiples don't necessarily apply, at least to some of these companies, don't necessarily apply in the same way that we have in the past. But of course, that doesn't stop the bears and the naysayers from looking at those traditional multiples and saying, look, I mean, there may be a future here, but at least current pricing seems to suggest that some of these stocks are way overvalued.
Yeah, and look, the haters, I mean, they'll sit there, those bears sitting in the hibernation caves, right? They can't find AI in the spreadsheets. But it's our view. You have to look out 3, 5, 7 years what the monetization opportunities looks like. If you believe on the consumer side, the next stage of AI, then Meta is a 4-digit stock. But it speaks to my view that if you just focus on 1-year valuation, you miss every transformational growth stock the last 20 years.
You mentioned Meta as a winner here. We're paying attention to Uber. What's a company that people are not paying enough attention to that could be a stealth winner here?
I mean, I think it's IBM. I think there's a renaissance that's happening at IBM in our monk. I think Arvind's doing a great job, and that's further and further monetization. I think institution that's still very under-owned, taking a page out of Microsoft's playbook, and I think it just shows you're now seeing tech spread to the second, third, fourth derivatives. That's why we have our Ives AI 30. It's not just about 2, 3 names. Of course, it's led by Godfather of AI, Jensen, NVIDIA, but it's spread to the rest of tech. And that's why it continues to be 10 p.m. in the AI party that goes to 4 a.m.
All right, Dan Ives, Managing Director and Global Head of Technology Research at Webush Securities.
You know, as somebody who goes to bed at 10 p.m., that's kind of worrying for me. But I get to his point. And I think it's interesting, too, how you brought up IBM. I mean, that hit a record high on Tuesday. And yesterday, we were talking about Micron. I know the shares are down a little bit today. But the idea that some of these old tech companies and Oracle, for example, are really benefiting from this new tech of AI.
Well, or people are just looking for new names to bet on. I mean, IBM is up 33% this year, and if you look over the past 12 months, it's actually up 75% total return versus 22% gain for the Mag 7.
Yeah, and some of it, so it's not just window dressing. I mean, these companies have the capabilities. A lot of people remember when Larry Ellison walked out with Trump for the whole Stargate initiative. Everyone was like, why is Oracle there? And it was like, well, there's only a few companies that have the capabilities to build these things in the scale
like, it's our turn now.
To do. Yeah.
All right, coming up, we're going to speak to award-winning filmmaker R.J. Cutler about his latest project, a docu-series covering the inaugural Esports World Cup. This is The Close on Bloomberg.
3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Scarlett Fu.
You know, Scarlett, I was taking a look at some interesting statistics about, what we stream on television, what we see in the movies, and I know you're a big streamer here.
Yeah, and you don't watch anything.
It's probably no secret that documentaries sort of just rule everything right now. And I saw this interesting stat that it says that basically since 2019, just in the last 6 years, that the number of first-run unscripted shows, so effectively documentaries, has risen from less than 600 to more than 1,300 right now.
It's pretty amazing. And I think once people hook on to someone that they're interested in, then they go, down the rabbit hole and are looking for anything they can get their hands on because they're so fascinated by that person. And something like a documentary really puts it all in context in one place.
And well, our next guest, he knows a lot about that. He is an award-winning documentary filmmaker covering several subjects. Dick Cheney, Anna Wintour. Who else am I forgetting here? Quite a few other folks here. And Martha Stewart, thank you very much. And his latest project is on esports. In fact, the Esports World Cup Level Up, which tracks several players who are competing in the 8-week tournament that kicks off next week in Saudi Arabia. Pleased to say that R.J. Cutler joins us right now, the founder of This Machine Filmworks. R.J., great to have you here. Let's talk about esports for a second here because, a few years ago, I don't think a documentary like this would have gotten much traction, but esports has become a big deal. Obviously, this World Cup, the second year that we've had it right now, kicks off, I believe, the first week of July over in Saudi Arabia. You had a chance to spend a lot of time with these players. What was the biggest takeaway that you had when watching these folks compared to some of the other documentary subjects that you've had?
Well, first of all, thanks so much for having me. We are very excited about this series that's on Amazon Prime. Folks can watch, as of this weekend, all 5 episodes that tell the story of the very first World Cup season, which was last year. And what we learned is that we're dealing with world-class athletes who are at the top of their game. It's not the cliche of gamers who are kind of, buried in their basement and not big personalities. You're talking about players whose profiles and fans whose passion and enthusiasm is as strong as you would see in the NBA today, and then as strong as you were seeing last week during the NBA Finals. They're incredible characters with high-stakes stories to tell who are playing for not just national pride and team pride, but for, in many cases, for the survival of their families, for the stakes, as I say. We're talking $60 million in prizes last year.
Yeah.
And in this, in the World Cup that's coming up starting next week, there's going to be $70 million in prizes.
I had a chance to watch the very first episode of this, and it was fascinating. Not necessarily a topic that I would normally spend a lot of time on. And I am curious how you picture subjects. I mean, obviously, you've had some that were ready-made. Of course, the Martha Stewart documentary got a lot of traction. There was just an announcement that your film company will be producing an Olivia Newton-John series, which I'm actually into. How do you pick your subjects?
Oh, well, as a filmmaker, we're really looking for stories that we can tell that not only give unique insight into the world that we're living in, but allow us to explore great themes. The Martha Stewart film was a movie about American womanhood. This series, Esports World Cup, Level Up, is about the formation of a whole new sport. And it's taking place in Saudi Arabia, in a fascinating part of the world, with these remarkable figures who are coming from all over the world to play at the height of their game. Martha Stewart, again, is a great platform for storytelling. Billie Eilish, who I made a film about when she was just 16 and 17 years old, gave us the opportunity not only to explore these two young artists, Billie and her brother, but to tell stories about family and what it means to have kids, and to watch those kids who are remarkable artists come of age. Every film we make, we think of as the same way we would think of a scripted film. Films are exploring character, they're exploring drama, they're exploring high-stakes stories. And I think this is why, as you say, we're finding the audiences around the world are really embracing our films.
It's curious to me because at a time when celebrities are so much more directly accessible than when Romaine and I were growing up because of social media, why are celebrity documentaries doing so well? There's no shortage of information available on these folks. Why is there demand for this kind of specific content packaged in this way?
Well, again, I think it has to do with the fact that you're seeing filmmakers who are exploring these life stories in a way that is so satisfying. So you wouldn't really ask why were we so excited by a movie about Leonard Bernstein two Oscar seasons ago? Why were we so excited about a movie by Christopher Nolan about J. Robert Oppenheimer? Those are scripted movies that we understand. We're going to be telling big cinematic stories. And with somebody like Martha Stewart, with somebody like Elton John, who we made a film about last year, with somebody like Billie Eilish, Olivia Newton-John, Anna Wintour, we have these opportunities to explore the lives of these extraordinary people who are performing at the height of their level and passion at what they do, and are doing everything they can to achieve greatness. And that's a lot of what who are having an enormous impact on the world. So these are people whose lives allow us to make great cinema and make great movies that people enjoy. So it's an exciting time to be working in our field.
RJ, at the same time, the production of those kinds of documentaries are a lot lower, the production costs, than traditional films that require a lot of CGI and a lot of special effects and all of that. Talk a little bit about how the business of Hollywood and the cost of producing content in Hollywood has influenced you in terms of how you look for your subject matter and how you tell your story.
I mean, the truth is that I started doing this in 1992 with The War Room, which was a film about Bill Clinton's presidential campaign, directed by D.A. Pennebaker and Chris Hedges. It was Oscar nominated. This was 33 years ago. And the conviction then was that nonfiction films could be a popular art form and command a big audience. And we are finding with the advent of streaming services that can reach that big audience that of course we were right. And as a result, there are resources to do this, because reaching you as an audience member with a film that only costs, you know, a few $1 million, as opposed to a film that costs tens, if not hundreds of millions of dollars, I'm still reaching you. And it's cost effective to the streamers with the right films. And it's also the audience return is fantastic. So you know, look, it's a complicated business for everybody in the entertainment world right now, but the streamers have proven that this is the popular art form we've known all along it was going to be, and that it was. Yeah, and we see that in the streaming. We've even seen that in the podcast space. RJ, before we let you go, I do want to get your thoughts here on some breaking news that we had earlier today. That Anna Wintour, of course, the longtime editor of Vogue magazine, is going to relinquish her role as head of American editorial content. This is obviously a huge milestone, and you actually made a great documentary about her, really about Vogue, several years ago. I'm wondering if you just kind of reflect on the process of making that documentary and about somebody who is pretty much singularly identified with Vogue magazine. Not just with Vogue magazine, but with Anna Wintour, you have somebody who's singularly identified with the fashion industry. And I think people need to realize what a monumental moment this is. Perhaps the greatest editor who ever lived of any magazine, certainly the single most influential figure in the global, multi-billion-dollar global fashion industry, Anna Wintour, who personally kind of stewarded the fashion industry, celebrated so many young designers, developed their careers, worked with the retailers to make sure that the industry thrived and survived difficult times like 9/11 in New York and other things like that. This is a titan. This is a woman who has gathered around her incredible talent for decades, devoted to her vision, and they've achieved at the highest level. And, you know, print journalism, as we know, and print magazines are changing. And with Anna's retirement, you're going to see a great other change. But I feel like today is a day where we must celebrate the remarkable achievement of her career, because we're unlikely to ever see a figure like her again.
RJ Cutler, really appreciate your joining us. RJ Cutler is the award-winning filmmaker. Thank you so much.
And probably the most famous bob cut in history.
Most famous bob cut?
Bob here.
Oh, on Anna Wintour. I thought you were talking about RJ. I was like, I didn't see a bob on him. But, you know.
Thanks, Scarlett.
I think about Anna Wintour and I just think about Meryl Streep and what she says. So the two don't meet necessarily. Coming up, big tech trying to break onto the big screen. That and more with IMAX CEO Richard Gelfond next. This is The Close on Bloomberg. Apple is betting on the big screen. The tech giant's F1 film starring Brad Pitt lands in theaters tomorrow after an IMAX premiere earlier this week at Radio City Music Hall, as well as an early screening at the Monaco Grand Prix in May. This marks Apple's highest budget theatrical release ever, and a huge gamble after going back to the drawing board on its big ticket movie strategy last year. We're joined now live in studio by a key stakeholder in this release and in the overall film world. He is IMAX CEO Richard Gelfond. Richard, good to see you again.
Great to see you both again.
Absolutely.
So what's interesting for F1 is that Apple prioritized securing a release on IMAX before finding a studio partner for the movie. Do you chalk that up to Apple being a tech company first and that having that kind of tech mindset?
I chalk it up to the fact that we had really good box office experiences with Apple before. So when they did Napoleon, even though it wasn't filmed for IMAX, they released it in IMAX theaters, and the box office was really strong. And I also attribute it to the fact that Joe Kosinski, the director who did Top Gun, and Jerry Bruckheimer, the famous producer, had worked a lot in IMAX, and they knew that their vision would come across better. And frequently in IMAX, the filmmakers really, you know, call those kinds of things. And they felt the best way to show it would be in IMAX. And as a matter of fact, Joe Kosinski built special IMAX cameras on every car. There are 15 IMAX cameras, obviously miniature, and they're remote controlled. And if you saw it in IMAX, you would say, oh, I get it.
I'm glad you bring up Joe Kosinski, who's a longtime IMAX partner, and of course, Chris Nolan, another longtime IMAX partner as well. How do you go about finding new talent, new director talent? Do you go out to them and seek them out, or do they come to you?
Well, these days, more they come to us because they've seen the results from things like Sinners or Oppenheimer. But we actively, over the years, have reached out. So we have seminars. We have an IMAX theater at USC Film School that the students actually work on and learn on. So we're always trying to generate, new IMAX fans and new IMAX filmmakers who want to work with us.
I'm curious, too. I mean, with F1, I mean, you've already got some good kudos on this film from Lewis Hamilton, of course, who was involved in the production of it. But I thought it was interesting. He gave a whole interview about how difficult it was to film racing overall, particularly Formula One racing. And he talked about the use of the cameras, the positioning of those cameras, and how it gave a much more, the most realistic, in his view, realistic view of what F1 is really like, from not just the look of it, but the sound of it when it hits those turns. Is that because of the IMAX cameras being used from the start, or is that something that's done in post-production?
It's because it was used from the start. And in fact, the entire film was shot with IMAX digital cameras, every segment of it. And as I was describing the camera and the way it can be rotated, it's just really interesting from a viewer's point of view, because you're on a straightaway going into a turn, but they can, using remote controls, the cameras can pivot. So you really feel like you're in the race. As a matter of fact, last night I was at a screening of it, and a lot of people in the audience said, they really felt like it in that way. And Lewis Hamilton said this is the closest he thinks people can get to feeling like what it's like to be in a race.
Yeah, and I haven't had a chance to see it, but I grew up on with open wheel racing, so I'm really curious to see like how much you were able to capture that. You've had quite a few movies come out this year in the U.S., but you've also had some considerable success in China. You have a movie out now right now, She's Got No Name over there. You've got another big one that I think is anticipated to come out on July 5th, as well as a couple others. What has been the pickup in the Chinese market for IMAX films?
Well, you can't mention the Chinese market this year without Ne Zha 2. And that's a film that did over $2 billion. And to put it in context, no movie outside North America has ever done over $1 billion. So this was explosive growth. And I think probably pent-up demand because of the pandemic going on. Certainly a lot more invested in movies in China. And as you said, the slate this year is pretty good. The summer slate's very good. We also have a network of 800 theaters in China, which is a big part of their theater infrastructure. So we deliver very strong numbers. The brand is very well known, and the filmmakers really lean into it.
Speaking of theater infrastructure, I mentioned Radio City Music Hall earlier because IMAX built the first ever IMAX pop-up screen at the vaunted venue in order to air F1, to show F1. Is that something you could do anywhere in the world? And I wonder how much of that is something you'll be employing in new locations, destination locations, to really showcase the technology.
I think you only want to do it for a blockbuster movie, one that you really has scope and scale, because needless to say, I mean, it's not the most money, but it's expensive to do that. And two of my favorite, well, three. One was in the Tokyo Dome, where 30,000 people came for a premiere, where we did an outdoor theater. We did one in the Great Wall of China, and that did really, really well doing it. And we've just done it. We've done it on ships. We've put them in all kinds of places. And I think it really helps the buzz about it. But one thing I wanted to mention also, we talked about the racing aspect of it, but F1, even if you're not a racing fan, it has a really good story. It's different, but it's like Top Gun in a racing car. So it really has a great
like
plot,
Days of Thunder.
interest, right? It's a really interesting movie.
The last time you were here, we were talking a lot about the idea of directors coming to you, and you gave a great anecdote about Tom Cruise and the latest Mission Impossible movie, which I did have a chance to see. And at the start of that movie, at least in the theater I was in, IMAX theater I was in, he basically gives a thank you to the audience, and he kind of extols the virtues of this is how movies should be made, and more importantly, this is how they should be seen. When you think about the future of how we consume movies, do you think that your technology, and for that matter, some of the competing technologies to IMAX, are going to be what keeps people going to the theaters rather than just watching at home?
I mean, I think it depends on the market. So obviously in really rural areas, you can't, the economics for an IMAX theater don't work. But in big cities and globally around the world, there's been a bigger move to premium post-pandemic because people stream a lot more than they used to. And I think they got a little bored of streaming movies during the pandemic. So I think if they're going to go out, they want something special. And I think that applies to concerts and other things. So I do think the trend line will continue.
All right, Rich, always a great conversation. Always wonderful to have you. That's the CEO of IMAX, Richard Gelfond. All right, we continue to count you down to the closing bells. Just about 9 minutes until we get there. Scarlett, 61.43 is where the S&P stands right now. At one point in the day, we did trade above that record high of 61.44.
Yeah, and if we continue to move up into the close, as we are currently right now, there's a leg up. Maybe we'll get there. But I suspect as you get to these record highs, we'll bounce around and kind of flirt with it, but not quite pierce it until a couple days later.
All right, you see the Magnificent Seven doing their best to keep the market afloat, and believe it or not, despite the fact that the rally off the lows in April has not been broad-based, the rally today certainly is. You see that reflected in a Russell 2000, up about 1.5% on the day. Garrett Melson joins us right now. He's portfolio strategist over at Natixis Investment Managers Solution. And Garrett, there's been a lot of talk about how much life there is left in what is a record rally as the S&P now crosses back above that record high from February. And I am curious if that is enough to pull you off the sidelines to maybe go overweight equities, or are you still comfortable staying neutral?
Yeah, well, thanks for having me, Romaine. You know, we certainly are cognizant of the risks for a continued grind to the upside here. You know, I think that's been a big driver over the last couple of weeks is just simply positioning. You know, we'd seen sentiment recover, but not get extended in the bullish direction. That's continued to play out. But I think the bigger story has been positioning from a systematics perspective. You just simply hadn't seen a lot of re-risking by a lot of the CTA and kind of more systematic investment strategies. That's been playing out, and I think that's helped to provide a kind of a stable bid to an uptrend in the market here. But I think the big issue for us in terms of chasing this is the fact that it still feels like the consensus is somewhat looking past the risks that we see in the market for the economic outlook. And that is to say that I think the Fed, as well as the market, is somewhat overly sanguine on the growth backdrop, and specifically with respect to the labor market. And so I do think we're somewhat setting ourselves up for a little bit of vulnerability here as we move through the summer months. Just when we look under the surface of the labor market, it certainly looks like cooling, and that could be a little bit of a scope for a pullback here over the next couple of months.
We definitely saw some evidence of that in the continuing claims numbers that we got out of those weekly initial jobless claims figures. But there is a question here, Garrett. I mean, it's one thing to have maybe some cracks in the economy or slight softness. It's another thing to have sort of a wholesale drop in consumption and economic activity. I am curious as to where you believe the economy is going. Is it going to move towards that sort of downward extreme, or is it just going to be something where maybe just some cracks around the edges?
Yeah, it's a very good distinction to make, and we're certainly not in the recession camp, and we weren't earlier this year. It's just simply a reflection of where we view the risks in the economy relative to the consensus. And there, I think it's simply a story of the path of travel for the economy here is one of slowly cooling activity, I think. And until I think the Fed starts to really pull forward those cuts, I think it's going to be a theme of basically growth at or modestly below trend for the foreseeable future here. So the risk, obviously, is one of passive tightening from the Fed. The fact that if we do continue to see this cooling and we don't see the Fed coming off the sidelines here, that's just simply exacerbating that cooling. But at the end of the day, I do think that the Fed has shown time and again that they are very reactive. They're willing to pivot on the data. And so I think that ultimately puts in a floor for just how much cooling we can see. But I do think it does set the market up for the potential for maybe not a growth scare, but a little bit of a growth startle.
You're certainly cautious, and I suspect a lot of institutional investors are as well. So when you look at this stock rally and who's driving it, retail investors, how much more, I guess, for lack of a better word, dry powder do they have to continue driving equity prices higher?
Yeah, again, when we look at a lot of the sentiment data, we look at the flow data, you haven't seen a significant amount of inflows chasing into this rally. And you certainly haven't seen sentiment get overly extended in here. So, I think there is quite a bit of dry powder on the sidelines that does put in a pretty good case for some upside in here. And it is why I think, we certainly don't want to be significantly underweight equity risk in here, because I do think that is a risk here over the next couple of weeks that, you don't have a whole lot of risk of maybe the labor market falling out of bed overnight. So that does set you up for maybe a little bit of a steady grind up here. But in terms of really chasing the rally, I think there's some the potential for a more attractive entry point, and that's when we start to see a little bit of a shift in the narrative coming back from this exuberance. Maybe not exuberance, that might be a little extreme of a term here, but optimism and starting to price in the reality of that cooling that is underway.
So, Garrett, we're looking at small caps right now outperform big caps. The Russell 2000 up by 1.6%. And over the past month, they've actually done better than big caps. But beyond that, they've been eternal laggards for the past 1 year, past 3 years, past 5 years, past 10 years. What actually catalyzes outperformance in this group? And I suspect you're going to say earnings. So at what point do the earnings come through? Is that something that we can see later this year?
Yeah, I think that's a tricky story, right? It's been a tough case for small caps because they certainly are more rate sensitive. And so when you price in lower rates, that should help the small cap story. The problem is over the past year or so, we've been pricing in lower rates because of slower growth. And so you kind of have this heads I win, tails you lose dynamic from reverse. It's a double whammy on small caps. I do think, though, as you look into the back half of the year, I think there is a potential that as the Fed starts to ease, you start to price in more of that cutting, that starts to stabilize growth expectations here. That might start to move in a more positive direction for small caps, one where you actually see easier financing rates that alleviate some of those pressures from a margin perspective.
Yeah.
And then on the flip side, a little bit more support from a top line perspective as growth starts to stabilize and those expectations start to rise.
Garrett, got to leave it there. Always a pleasure. Garrett Melson, portfolio strategist at Natixis Investment Managers Solutions, helping us count you down to those closing bells. Just about 3 minutes to go, and seeing a lot of buying activity as we move closer to the close, potentially maybe off of a headline that just crossed the Bloomberg terminal that the Treasury Secretary of the United States has formally asked Congress to remove the so-called Section 899. This is that so-called revenge tax provision that a lot of people were afraid would actually discourage foreign investment in U.S. markets. Scott Bessent making that comment in a social media post on X, saying he asked both the Senate and the House to remove Section 899 from the budget bill.
So once you remove that, does that revive this idea of American exceptionalism? We haven't used that term to describe the rally that we're seeing this time around. But remember, earlier in the year, that was very much intact.
Yeah, I mean, there's a lot of things in that bill that I think were scaring markets, but that was a big one too, because like I said, you were Xing out a huge potential population of potential buyers. 6145 and change right now on the S&P 500, above its record high. A full breakdown of all of today's market action that starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick here with Scarlett Fu, taking you through to the closing bell with a global simulcast. Carol Massar and Tim Stenovic join us now from the radio booth. Welcome to our audiences across all of our Bloomberg platforms, including our partnership with YouTube. It was 61.44. That was the high on the S&P 500 back in February. As of right now, Carol Massar, don't jinx it, the S&P is trading above it.
No, it just went below it. So it's like, we're right there. We're right there. Don't blame me. Don't blame me. But listen, we've been fixated, right? But it's pretty interesting to see quite a rally underway. And investors seem to be pretty enthusiastic. And there's some expectations of some Fed rate cuts. So maybe that's helping out a little bit.
Yeah, 2 decimal places is where things go in our data. So we could still be at a record even if we are at 61.44, depending on the decimal places. I asked this question to Eric Weiner earlier, who covers markets for our Equities Americas team. And he's essentially saying something that I think Scarlett and you said earlier this week, which is that everyone's betting that this 90-day pause that expires on July 9th gets extended by a significant period of time, because what is not priced in are those tariffs going back up in just a few days.
Absolutely. And of course, we got the headline just moments ago that the Treasury will exclude U.S. companies from some taxes imposed by other countries. That's the deal with the G7 in exchange for removing the revenge tax bill from President Trump's one big, beautiful bill. That seemed to be the impetus for the last minute rally.
It gets to the idea, though, too, of how many loose ends are out there. You mentioned trade. Obviously, we're talking about this budget bill, which still has to be addressed. And then there's still the geopolitical issues, but certainly not as much chaos and uncertainty as we had a couple of months ago. And that, of course, might be a big part of the reason why we've continued to see such strength in U.S. financial markets, including on this Thursday afternoon. The S&P 500 has now rallied about 23% from those April lows back on April 8th. And it looks like today it's going to settle right around 61.44 and change. That would be below the all-time record high of 61.44.15. But I think folks will take it. A gain of 0.8% on the day. The Dow adding 400 points or 0.9%. The NASDAQ composite up a percentage point on the day. The NASDAQ 100, a fresh record high, up more than 200 points or 0.9%. And the Russell 2000, believe it or not, that's your outperformer, Carol Masser, up more than 35 points or 1.7%.
Yeah, interesting to see, right, that outperformance, and maybe that reads, some expectations about the domestic economy. Having said that, if you dig into the S&P 500, we've seen more names in the index higher today. I don't know why, but my terminal's a little slow right now. There we go. 372 names to the upside, 130 to the downside.
Absolutely, and that is reflected in the IMAP as well, which looks at the S&P 500 and its 11 industry sectors. And you can see that the decliners here are really pretty small slices of the market. REITs are down about 0.6%. Consumer staples, a traditional haven, defensive group, down about 0.2%. The outperformers here, communication services up almost 1.8%. Energy and consumer discretionary each gaining more than 1%.
All right, everybody, let's get to some of the individual gainers. And first, ticker FUL. We're talking about HB Fuller.
What'd you say?
I said FUL.
Oh, sorry.
Hey,
she would never to you, Roman.
All right, that stock, wow, up almost 11% in today's session. Stock up after Citi maintained its neutral rating and $62 price target for the paints and coatings maker, noting better than expected volumes and strong engineering adhesive margins. Keep in mind that the company last night boosted earnings per share guidance for the full year that beat the average analyst estimate. So upbeat earnings, upbeat commentary. And so you've got HB Fuller, I'm not even going to say the ticker again, is definitely an outperformer. I'm going to go to Circle as well, because that one continues to kind of bounce around a little bit, but we did see some more outperformance. The stock rising in today's session, up another, 7.5% in today's session. That's after falling about 25% the 2 days prior. More players beginning to enter the stablecoin industry since the U.S. Senate passed stablecoin legislation. So we continue to see some interest in that one. There was also a note, our own Bloomberg Intelligence, Dick Garrett putting out a note and said, Circle's post IPO surge and fresh interest from JP Morgan, Walmart, and Amazon suggests that stablecoins, blockchain-based tokens tied to traditional currencies, are moving from the fringe into the financial mainstream. And so Circle certainly stands to benefit. And let me go to one more, NVIDIA, just because, we saw this one again among the largest market cap companies out there. That was courtesy of that 4% gain yesterday, adding another 0.5%. So I just wanted to kind of throw that out there. And that one has bounced quite a bit from those April lows, and it's now up about 15% this year. But I think it's up about 50, 60%. I had the number in front of me and I lost it.
I just add thanks for that, Carol. I'm going to add a couple of honorable mentions. QuantumScape up 34%, yes. And then we were watching Core Scientific. They closed up higher by 33% on the back of that speculation that CoreWeave might actually be interested in buying the company.
Okay. A difficult day to find prominent decliners. I do want to start with Micron. We reported those numbers after the bell yesterday, down today by 1%. It was an outlook that wasn't quite rosy enough to keep that 2025 rally going, despite posting third quarter results and a fourth quarter forecast that did exceed estimates. It is still up around 49%, more than 49% so far this year. The company's high bandwidth memory sales are surging. The company, though, did not predict the kind of runaway growth that some investors were looking for. So we saw the stock decline today.
But it's like doubled since April 8th,
yeah,
right?
It's pretty remarkable. But, investors, they're looking for a lot right now. And look, the gains this year have been pretty amazing.
Well, the concern was, right, we just talked about that,
we
right?
did, yeah.
Yeah. About the prices and
Yeah.
I'm sorry, I was listening.
That's okay.
Sorry, I'm a little distracted today.
Wow.
I was watching the S&P, seeing if it would close at a record high. Her mind's still on it.
Scarlett, man, I love you. Go ahead.
Okay. Scarlett mentioned REITs. Spot of red in the S&P 500 today. Equinix, the worst performer in the S&P 500 on a percentage
Equinox,
basis.
right?
EQIX is, you guys see what I have to deal with daily? But it's fine. I mean, Scarlett, you kind of deal with the same thing, right? I don't know.
Romaine interrupted?
What?
No,
Yeah.
never.
How dare you?
It slumped as much as 14% a little earlier in the session, but it's off its worst levels of the day to close down 9.6%. That was its biggest intraday decline since March of 2020. The company's long-term outlook disappoints investors. It resulted in at least 2 downgrades. This news was yesterday, though. The downgrades were first provided, or the targets rather, were first provided to Analyst Day Wednesday, resulting in a 9.1% drop. And finally, well, this is now a micro cap. It used to be a small cap before today. Altimmune Inc. down 53%. A clinical stage biopharma company. Shares plunged. The company said a mid-stage trial for its experimental therapy for a fatty liver disease showed the drug was not significantly different from a placebo when treating fibrosis.
All right, let's take a look at where yields are. In fact, seeing continuing downdraft, particularly on the short end of the curve. This is the 8th straight day, actually, that we've seen the 2-year yield move lower, down about 7 basis points on the day. And we continue to talk about the steepening of that curve. You see that reflected in the 30-year yield, which, of course, only fell about 3 basis points, so about half of the move that we saw on the 2-year.
All right. Let's get to some stories that are definitely on our radar. And I don't know if you guys saw this one. It's now, I think, the 3rd most read story on the Bloomberg in the past 60 minutes. But there's something going on in the driverless car space because you have the New York Times coming out just within the last hour or so and saying that Uber is in talks to basically have its founder, Travis Kalanick, come back and help fund a self-driving car deal and essentially help them buy a autonomous vehicle startup as they continue to kind of watch Waymo gain momentum. But they also keep doing deals with Waymo.
Yeah, this is a little wild here. I mean, it's clear that Uber is concerned about the possibility of self-driving cars. This is nothing new, though. I mean, Uber had its own advanced technologies group. It was called ATG. And this was started under Travis Kalanick before he was ousted as CEO years ago, and Dara Khosrowshahi took his place. Khosrowshahi sold the ATG group to Aurora Innovation back in December of 2020.
Yeah.
So it's like things have really kind of gone full circle here.
I can't wait to see the follow-up movie that describes how this all came together.
If it happens, right?
That's
How
really
does,
funny.
I don't understand, like, if it's an autonomous vehicle, who's Travis Kalanick going to yell at?
There's always an engineer to be yelled at.
Too soon? Oh, sorry.
Too soon.
I'm not the one who yells at my Uber driver.
Carol, you mentioned Circle
There was
and
that video.
CoreWeave earlier.
There was the video. That's the video you're referring to.
Yeah, we got it.
All right, Scarlett's got something. Let's go on. Let's move on.
Carol, you mentioned Circle and CoreWeave earlier. Triple-digit increases for some of these companies that have recently gone public. It's led to the IPO class of 2025 showing some pretty impressive returns, a weighted average of about 53% gains here. And of course, that raises all kinds of questions about whether we're going to see more IPOs coming up because the returns have been pretty good.
That's a sign of a healthy market.
Yeah.
Or a sign, right?
Yeah.
Yeah.
Hey, just speaking of the return of old folks back to their former companies, Marissa Mayer, remember her?
Yeah.
Yahoo.
Yeah.
Actually appointed to Starbucks' board. Also Ambassador Dambisa Moyo also getting appointed there as well. That's all, Carol.
Watching
Wrap it
people
up.
on the move. Thank you
Yeah,
so much,
sure
Romaine
thing.
Bostic.
Sure,
All right,
breaking
that is a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals, folks. We call it the closing bell. Scarlett and Romaine continuing there on TV, and Tim and I are going to continue here on Bloomberg Business Week Daily. We will see you again, same time, same place tomorrow.
Our coverage continues here on Bloomberg Television. We're going to divest the near record run for U.S. stocks, and we're going to digest earnings. Yeah, earnings still going on, awaiting a report from Nike. Stick with us. This is Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. An interesting day on Wall Street. The dollar was down, yields were down, and so too was the VIX. But of course, stocks had a near record run. The NASDAQ 100 did close out at a fresh record high, and the S&P 500 trying to catch up with the rest of that cohort, up about 0.8%. It did trade above its all-time high of 61.44, but as you can see on the screen there, it did close just a smidge below that. A lot of talk now going forward as to sort of what moves this market next. You did see the KBW index rally, believe it or not, potentially back to a record high that it hasn't had in at least 3 years. And you also saw a lot of strength, of course, when it came to chip stocks in the semiconductor space.
All right, let's stay with the tech space overall here, because Core Scientific rallying 33% on the day. The Wall Street Journal reporting that CoreWeave, which finished down about 1%, is in talks to buy the data center operator after failing to buy it about a year ago because that company deemed the offer price too low. We're also looking at Equinix. It's a REIT. It's a data center REIT specifically, dropping as much as 14%. That's the most in 15 years. The long-term outlook disappointed investors. The company trying to shift its business to better position for AI-based demand. The results and the outlook prompted at least 2 analysts to downgrade the stock. We're going to stay with earnings because our top story this hour is Nike. It's on the on-deck circle here. The athletic footwear and apparel giant will report earnings in the next couple of minutes, and investors hoping for a turnaround probably won't see it reflected in the numbers just yet. Revenue last quarter likely plunged 87%. That is the most since 2020. Really raising the question of whether Nike has hit bottom yet. New CEO but longtime executive Elliott Hill is trying to reset the business, clearing out inventory, firming up wholesale partnerships, and of course, managing the impact of tariffs at a time when consumers are getting a lot choosier on how they spend. Romaine?
Poonam Goyal joins us right now, our person over at Bloomberg Intelligence who covers this company. And as we await those earnings, Poonam, there are a lot of questions, not so much about the quarter that just was, but really about the idea of what Elliott Hill is trying to do. What has he done so far? And more importantly, are investors on board?
Yes, you're absolutely right. The numbers we know won't look that great, but I think what we're watching for is the inventory levels here and where they will come in. So we saw inventories were down just 2% at the end of last quarter, but sales were down double digits. We really need to see those inventory levels come down more. And if we see that today, that is a great sign. The other thing is, you mentioned, what is he doing? What is he doing to turn this company around? And I think we need to focus on newness. The new brands that he's introducing within the Nike umbrella, the drops that are coming through, the innovation that we're seeing in designs, not only for sportswear, but also for style. And we do see him pushing that across.
Which one is more lucrative? Or maybe the better way to put it is, which one is more important for convincing investors it's got its groove back? For the performer or for the casual user?
I think the performer is more important. And the reason I say that is because a lot of the performance shoes are worn every day too, right? So as long as you have the shoe right, it's comfortable, it can perform. We're seeing a lot of these performance shoes being worn on the streets. So if I had to choose one, I would say performance.
I am curious just about the idea of the melding between performance and design fashion. We've seen kind of those lines really blurred. And Nike for a while, I think, did it great. But there was a lot of concern about whether it was saturating the market with too many styles, the idea that some of the styles that it was saturating the market with, it didn't leave on the market long enough for people who really wanted it to buy. Is that something that you think needs correcting?
I think it's being corrected, right? So we already saw that Nike didn't have a balance on how much it produced. It produced too much of, certain styles, and we're seeing them trying to get rid of them today. Yeah. And then it didn't produce enough of some. When a style's hot, you don't want to overproduce, but you also don't want to underproduce. Yeah. And that's what gives birth to the resale market, which we are seeing, the drop that's expected tomorrow.
Hey, Poonam, hold that thought for just 1 second. In conversation with Poonam Goyal at Bloomberg Intelligence, Nike earnings crossing the wire right now. Revenue did drop 12% in the most recent quarter to $11 billion. But believe it or not, that was actually better than anticipated. Your inventory numbers, $7.49 billion. The street was looking for $7.17 billion. Gross gross margin came in at 40.3%, which is pretty much on the nose, Scarlett, of where investors had expected. And here's your bottom line number, EPS 14 cents a share. The street, not quite sure the comparison, but year over year, that's down from 99 cents the previous year.
Right. And again, we just want to reiterate that Nike's revenue coming in better than expected, but it is still a huge decline compared to a year ago. So Poonam, just getting a quick glimpse of these numbers here. We're looking at the stock moving around in the after hours trade, currently down about 1.9%. When you look at that inventory number, $7.49 billion, down about 0.4% year over year, higher than what was estimated. What does that tell you?
It tells me that they still have a lot of work cut out for them. Unless we find out that the mix of that inventory is more new inventory and the old inventory is actually down more, this is not good, because we do need to see the inventory fall more. Results were better, but I really want to know what the mix of that inventory looks like.
Yeah, and to that end, the company's saying that the results are in line with expectations, but not what we want. So moving forward, they are looking for the business to improve as a result of the progress that we're making with the various initiatives, our Win Now actions, according to Elliot Hill, the president and CEO of Nike. Poonam, thank you so much. Poonam Goyal of Bloomberg Intelligence. Let's get another perspective here on Nike as we look at the shares extend their decline, now down 1.5% in after hours trading. Stacey Widlitz is president and founder at SW Retail Advisors. Stacey, this sense that Nike might have reached bottom in the fourth quarter, fiscal fourth quarter, given that the inventory numbers were higher than what was anticipated, is that idea now moot?
I think that idea now, let's face it, this was supposed to be the kitchen sink quarter, and we were hoping to see some improvement in inventory, and we didn't see as much as we had hoped for. So perhaps that pushes the story back a bit. And we know this is a long-term turnaround story, but I think the issue is you have to really clear out those classics, the dunks and the other things that have been so over pushed into the market. And also, as they shrink those classics, you have to replace that with newness. And the newness, of course, is all coming at full price. They're no longer discounting. So if the brand halo has been damaged, the question is how do consumers come back into the market and say, we want Nike and we're going to pay full price for it?
And this is something that you can't fix with resetting wholesale partnerships, is it?
Well, I think it's important to do that because obviously Nike, prior to Elliot coming on, really kind of turned its back on its wholesale partners, which was a mistake. And he's trying to repair that and say, hey, let's work together as a team. Let's bring in the feedback loop so we don't have too much in the market. By the way, we're going to take stuff back from you if it doesn't sell, and we're going to sell it in factory, which is great for Nike because they get the markdown business. So it's more of a collaborative approach. And yes, it helps the market and it helps the brand halo by not having too much stuff in the market at discounted prices.
Well, I'm curious about how they reverse that, though, Stacey, because I could just tell you anecdotally. I've seen way more sales being offered on Nike products over the past year than I had ever seen in previous years. In fact, that was always, as someone who loves Nike, that was always the bugaboo, is you pretty much had to pay full price to get at least the more fashionable stuff. There's always that trap, though, that once you start going down this discounting road, it's hard to pull out of that. And I know you've covered retail, and we've seen so many retailers fall into this trap, like Gap and a few others. Has Nike gone too far down that? Is it is it too late, I guess?
Well, that's the big problem here, is that when you've had all those discounts in the market that you're talking about, whether it's at their partner Foot Locker, which is 65% exposed to Nike, or in their direct channel, particularly e-commerce, that they've been promoting so heavily, they've removed those promotions. So now it's like the consumer sitting there going, well, hey, there's nothing to entice us to pull the trigger. And of course, they're raising prices in some areas. And I would also say, looking into holiday, if they're taking stuff back from the market that's not working and selling it in their factory channel,
yeah,
could we make the argument that consumers are just going to go to their factory channel for it?
Yeah. The other thing I'm curious about is the marketing approach they take. And I know traditionally, of course, obviously going back to the big signing of Michael Jordan years ago, you sort of take a big name athlete, create a shoe line or some product line around them, and hopefully the money will run in. We've seen a shift, though, in what consumers are paying attention to. It's not just the athletes, it's just really anyone in the zeitgeist. I don't know where it stands right now, this partnership with Kim Kardashian with the Skims line. I know it got pushed back a little bit bit because of some production issues. But do you see more value, maybe potentially, in them partnering with, I guess, decidedly non-athletes like a Kardashian family?
Good question.
Yes, and we've seen that in the past through partnerships, whether it's Adidas, with Gucci. It doesn't have to be just athletes. It just has to be, you want to be attached to the cool factor, the person, the brand, whoever it is. And, you know, it's unfortunate that the Skims collaboration got pushed back here, but I would also say that Nike is trying to reach out to women who have largely been ignored, other than Lulu and Aloe and some others in the space, and trying to win that consumer back. So we'll probably see more of that from collaborations with female athletes.
All right, Stacey, always a pleasure. Stacey Widlitz, president and founder at SW Retail Advisors. And of course, we're waiting for that conference call at the start of the hour where hopefully Elliott Hill will maybe expand on that Skims partnership as well as other partnerships that Nike has in the works.
And that's part of the whole newness campaign that everyone's looking for. Worth noting here that Nike shares are now marginally higher by 2/3%. Our next guest is a veteran in the footwear industry. He has designed over 500 styles for athletes, including Derek Jeter and Michael Jordan, previously serving as design director of Nike's Jordan brand. He is now president and founder at Pensole Lewis College of Business and Design, the only design-focused HBCU, which, by the way, has partnerships with the industry's top brands and retailers, including Nike. I'm pleased to say Dr. Dwayne Edwards joins us now. Dwayne, thank you so much for taking the time to speak with us. We talk a lot about the Jordan brand and the Dunks and how Nike has to clear out a lot of inventory of the footwear that it's accumulated over the past couple of quarters. My question to you is, do you think from where you sit, Nike distilled the Jordan brand by releasing too many sneakers that it lost some of its scarcity value?
I don't know if I would say that completely lost some of its scarcity value. I think, you know, what Nike does and most brands do is they respond to consumer demand, right? And because of the demand and the love that people have with the Jordan brand, now we're talking about generational. This brand is 3 or 4 generations deep into the culture. And so that consumer demand, yes, you do have to kind of monitor how much you do release to keep a little bit of that scarcity. But at the same time, you still do have to generate revenue for your organization.
Absolutely. The one thing that came through in our talking to analysts is this idea that Nike needs to hit upon some newness. It needs to introduce some footwear that is fresh, that surprises and delights consumers. As a designer, how do you think about that when the company is still busy trying to clear out a certain look from years and years of overproduction and too much inventory? What do you look for?
Well, honestly, we're so far ahead of the process to where what you're talking about is current state, right?
Sure.
We're through 3 years ahead of the process. So for us is really understanding what was working and what is working, but then how do we predict what will work? And so I would say it's not necessarily, it's not an imperfect science, but the beauty of a brand like a Nike and a Jordan brand, there's so much history and legacy of just being competitive and leading the industry instead of following the industry. As long as the designer has that mindset of understanding, hey, we need to dictate what will be the newness versus trying to respond to current consumer demands when you're trying to design 2 and 3 years ahead.
I am curious, Dwayne, where sort of the next sort of generation of designers are coming from. Obviously, PLC is very focused on that. You've expanded this, of course, beyond its original location, including the partnership you had with StockX and what you guys did in Detroit earlier this year. When you look at those folks who are entering into this program, where do they actually want to move this market?
Well, honestly, it's really the actual customers of the product. How do we actually attract the people who have fell in love with the brand over the years to now help them understand what it could be like to actually create the things that they wish the brands would actually produce? And that is largely the role that PLC plays, is we work directly with the consumer. We help them understand in order for the newness to change that you like, you have to be the one that's going to generate that change. Nike and Jordan brand has been longtime partners of Pensole Lewis, even when we were at Pensole back in Portland. And of course, I've worked there for quite some time. They've been amazing partners with trying to understand how do they look for the next generation of talent that will move the brand into the next generation. And so it is truly the idea of identifying talent at a very early age, developing that talent. But the beauty of it is they're already invested in the brand itself. It's just helping them understand, taking that ability of like and now create.
I am curious what your thoughts here on some of the upstarts that have come into this industry and really made a splash, the On Holdings and Hokas of the world, brands that effectively kind of seemingly came out of nowhere and have grabbed a pretty sizable market share, whether it's in the fashion category or more in the sports performance category.
Well, I mean, they've been around for a little while. They just maybe showed up on the radar a little bit more than in the last few years. But I think it's healthy. I think it's healthy for Nike. I think it's healthy for Jordan Brand. I think it's healthy for the industry to be able to have that level of competitive diversity. As a creative, just like an athlete, you only get better by competing with someone who's doing something just as good as you or better than you. That makes you sharper. And I think the additions of Hoka and On and some of the others, that just makes the industry as a whole so much better. And I think you will see the increase of creativity that starts to occur, both on the lifestyle side and the performance side.
Curious, as we wrap up our conversation, Dwayne, as a designer, how much sway would you have in the pricing strategy that the company ultimately comes up with? Is it based on things like material and time spent on a specific design? I mean, are you thinking that when you start designing right away?
Yeah, well, most of the time, every design starts with a design brief, and you have a very specific targeted price point you want to hit and at retail. Then we would have to figure out how do we best design towards that price point to meet the desired margin target that the company can be profitable based on what we create against. So no, we don't necessarily dictate the retail price. We actually have to create within the retail price that's already established by the business.
All right, Dwayne, really appreciate you taking time. Dr. Dwayne Edwards, they're a legend in the footwear industry and now president and founder of Pensole Lewis College of Business and Design. All right, we need to make a hard pivot from that and go back down to Washington, where the President of the United States is holding an event in the East Room of the White House, talking about some of the trade deals that he's been working on, saying that he has made progress with China, making progress with India. Let's take a listen.
Already will have become a promise kept, and that's very important. Promises made, promises kept. And according to the Council of Economic Advisors, these reforms will protect or create more than 7 million jobs, add 3.1% to economic growth, reduce taxes for the typical American by nearly 15%, and increase take-home pay for the normal family of four by at least $13,000. And that takes place immediately. That's not bad, right? Look, I'm looking at that guy back there, right? That's pretty good. And if we had a person over at the Fed that would lower interest rates a little bit, that would be helpful, too. It's hard to believe. This is on top of, we have to fight this guy. He's not doing the job. Each point that he keeps it up is the equivalent of $300 billion. $300 billion. So if he lowered it to, it would save $600 billion. We have to work hard with cuts on that, right? That's a lot of cutting. And this guy could do it so easily. We don't have inflation. Well, we might have inflation. Yeah, and if you do, you raise the rate a little bit. That's okay. But we're going out because Biden gave us a lot of short-term debt. And given the short-term debt, he did us no favor. So I think what we'll do is we'll probably just extend the short-term debt and then go out, because I don't want to tie it up for 10 or 15 years at a high rate. But every point is it's really more, is $300 billion. So if we got it down to 1%, we're talking about almost $1 trillion in saving just with the stroke of a pen. No work, no missing anything, just like an accounting situation. Oh, Doug Collins, I just see Doug. Did I mention you, Doug? I don't think so. I'm glad I saw you. I'm glad that somebody's going to be in big trouble with you. They didn't write your name down, Doug. Somebody's in, I got you. So we think of that, though. We save, and all you have to do, it's so simple. I'm explaining to this guy, and Biden extended him. That wasn't good. I'm explaining to him, you can do so much for our country. You could save $1 trillion just with a stroke of a pen. Just a little, the utterance of a sentence.
And President Trump holding an event at the White House in Washington. Now, you can continue to monitor his comments. If you have a Bloomberg terminal, type live go, and you can see that in full. And of course, if we have any major headlines here that moves the market, we will break in and bring it to you as soon as we get them. And of course, you heard the president talking a lot about that budget and tax bill and really talking about this idea of U.S. exceptionalism. There's been a lot of concerns that exceptionalism might be fading, particularly in the fixed income market, as debt and inflation worries push investors out of long-dated U.S. bonds. The TLT ETF has actually seen 5 straight weeks of outflows. And our next guest says bond investors could actually do with adding some overseas exposure to their portfolios. Pleased to say joining us here in Studio 2 is Tom Becker, lead portfolio manager of the Global Tactical Asset Allocation team at BlackRock. Tom, great to have you here. All right, let's start talk about this rotation, because I think we've kind of gotten a little bit of a flavor of that. I do wonder what diversification outside of U.S. fixed income actually looks like.
Yeah, sure. So the stuff that you mentioned with the outflows, I think post-Liberation Day, some concerns about higher inflation. Next month's going to be a big month with the big, beautiful bill potentially making its way through reconciliation. And so what we're thinking is that the inflation risks from kind of the tariffs are yet to hit markets. There's going to be more bond issuance. I think U.S. bond investors are seeing that. And where we're positioned is we can go global into other government bonds, countries where inflation's lower, where the central bank's cutting rates. Today, Mexico cut 50 basis points. ECB's been cutting. And so we can kind of have the central banks on our side. We can hedge back the exchange rate risk and get a higher yield than we would get in U.S. Treasuries.
There's been a lot of talk that at some point the Fed will catch up with the rest of the world. A lot of discussion that the Fed will cut maybe twice this year, maybe 5 times based on what's pricing into the market by mid-2026 here. Would that sort of maybe even things out, or is this, not to borrow Trump's phrase, but too late?
Sure. Yeah. I mean, that's already in the price. Yeah. So the yield curve reflects those cuts. We're a little bit more optimistic on the economy. We think growth is going to be okay after that Q1 pothole. We think that inflation is going to stay closer to 3 than 2. And we think kind of this fiscal emergence that we're seeing with more fiscal, yet again in the U.S., continuing kind of buoying the economy. We think that's going to keep the economy in a place where the Fed can hold rates if they choose to. And these other economies have been kind of hitting some speed bumps with the tariffs. We think that's a really important thing for markets to be aware of.
We showed the TLT outflows, and obviously TLT is longer duration treasuries. If you look at ETFs that focus on shorter dated treasuries and shorter dated fixed income instruments, you're still seeing pretty healthy inflows into those areas.
Into the U.S. front end.
Yes. Yeah.
If you go into foreign government bonds, and you hedge the currency risk, you actually get a higher yield because a lot of those curves are more upward sloping. You've got a term premium in those foreign markets, and then the FX hedge brings back a little bit of extra yield. So optically, the low yields you'll see in those foreign countries actually gets elevated with an FX global product.
So what type of countries are we talking about? I mean, your folks have recently launched a new bond ETF that specifically focuses on that global dynamic that you're talking about. I mean, where are the heaviest weightings?
In general, we think broad diversification makes sense for kind of a benchmark. We manage it actively, but in terms of the starting point, it's just issuance weighted. So it's a mix of U.S., Europe, Japan, emerging markets. So we get that broad diversified exposure with the hedge to start. And then we take active positions going overweight and underweight, looking for those central banks that are on our side, looking for attractive real yields, and that gives us a really nice ballast in the portfolio.
I mean, what's the type of client that is looking for something like that? And I mean it on a geographic basis. Is it U.S. investors looking to diversify, or is it already foreign investors that were invested in the U.S. who maybe are looking to maybe retrench?
Yeah, good question. Yeah. If you think about a U.S. 60-40, that 40 is dominated by U.S. Treasury risk. So even though there's mortgages, even though there's corporate bonds in there, the main driver of kind of the returns of that is going to be U.S. Treasuries. And so we think that U.S. investors, as they're looking abroad on their equity side, seeing kind of foreign equity markets outperforming, they're going to realize that there's also attractive diversification that comes from growing abroad on your fixed income side as well.
How much does the recent weakness in the dollar factor into some of the activity we're seeing in the fixed income space?
Yeah, I think that the weakness in the dollar from our perspective is related to some global rebalancing. So just a view that trade flows are going to be a little bit lower given kind of frictions from tariffs. That makes U.S. assets maybe a little bit less attractive to foreigners, and they may park more of their fixed income at home in their own markets. Another tailwind.
With regards to the Fed here in the United States, and there's been a lot of talk, and I mean, you are an active fund, so I'm sure you have to sort of be cognizant of some of the politics around the Fed. The president just yesterday was talking about the idea of replacing Powell, or at least naming his replacement much earlier than you would traditionally do, which in theory I think would sort of put some pressure on Jay Powell that he probably wouldn't like. But I am curious as to how you sort of I guess, work through that noise, if you will, for lack of a better phrase, because it does have an effect on the psychology of the market.
Sure. Yeah. I mean, the market moves on those headlines. A schism kind of in the Eccles building would be challenging to make monetary policy. Our investment process looks at the macro data. So we're going to look at the U.S. growth prints, the leading indicators, inflation, how fiscal policy is shaping up for the economy, and then importantly, what's priced by markets already. You mentioned kind of all those cuts already priced into U.S. yields. To us, if we're a little bit more optimistic on the economy, we really think that yields can kind of rise in just a normal economy.
All right, Tom, got to leave it there. Great to have you.
Yeah, thank you.
Great conversation. Tom Becker, lead portfolio manager of the Global Tactical Asset Allocation team over at BlackRock. All right, stick with us. When we return, we're going to talk geopolitics, and we're going to talk about the birth of the United Nations and whether its 80-year long run might actually be coming to an end. This is Bloomberg. All right, welcome back. As the sun sets on the most recent NATO summit, a summit that ends with a sigh of relief over some semblance of unity to preserve the transnational military alliance, it's fitting that the meeting's culmination comes as another international body, the United Nations, celebrates its 80th anniversary. And that's our look back in history today to June 26, 1945, not even 2 months after Germany's surrender in World War II, and still 3 months before the U.S. dropped atomic bombs on Japan. Delegates from 50 nations, including China, France, Poland, and of course the U.S., signed a charter for an international coalition to prevent a repeat of the deadliest conflict in human history. The charter was explicit: save future generations from the scourge of war by promoting global cooperation. The United Nations would become the cornerstone of global stability. At the time, the UN was a relatively easy sell to a public that was weary from 2 world wars that had claimed the lives of more than 100 million people. In fact, 80% of respondents to a Gallup poll at the time said they wanted the U.S. to, quote, join a world organization with police power to maintain world peace. But times have changed, bigly. By the 1980s, bashing the UN became political sport in the United States as the organization's mission evolved from a clear-cut directive to maintain global security to, well, squishier ideals like famine relief, disaster assistance, and climate change. And on this 80th anniversary, the U.S. is now threatening to deliver a body blow to the organization that it helped to found and lead. President Donald Trump and his federal budget, and that wish list in that budget includes no money allocated for peacekeeping or even for operating the UN headquarters, and little for foreign aid at all. He has already withdrawn the U.S. from UN programs like the World Health Organization, the Human Rights Commission, and of course the Paris Climate Accords, and has proudly disregarded UN agreements governing international borders, waters, and refugees. Now, Trump's full plans for the UN will come into better focus next month. That's when his team is scheduled to issue a report on its review of U.S.-UN relations, a report that no one expects will champion the ethos of that charter signed back on this day in 1945. And as we take a look back in history at the UN, we circle back to today and the President of the United States speaking right now at the White House, talking about his big, beautiful budget bill, a bill that he says is the cornerstone of his agenda, a bill that will codify that agenda, in his words. Joining us right now is Jennifer Flitton. She's head of U.S. government affairs over at Invesco. And Jennifer, I do want to start with this bill, a bill that looks like it is gaining some traction, as we've now gotten some headlines that some of the provisions that were sticking points, like the revenge tax and some of the health care measures, might actually be, if not taken out of the bill, significantly rolled back. What are the chances that this gets passed and on the president's desk within the next few weeks?
I think there's a very good chance. And whether it happens by the July 4th deadline or, prior to the August recess, I think the momentum is there. And we're really in this crunch time, right? So the parliamentarians making their review, the rewriting, the redrafting is happening right now with the Senate. The negotiations are happening not just between the House and Senate, but Treasury is involved as well, especially with the SALT caucus. I think they're going up there again this afternoon. So the ball is rolling, and we expect to see some text out of the Senate either tomorrow or Saturday.
Well, let's talk about SALT. This is the state and local tax deduction, of course, that is near and dear to anyone who owns a home in New York. That, of course, got rolled back during the first Trump administration. The representatives for New York and the senators for New York have pretty much held the line on this for most of these negotiations. And I am curious if you think they have enough clout and power, Jennifer, to ensure that that SALT cap is indeed increased significantly.
Right, that's right. It's New York, it's California members, it's members in purple districts. These are the majority makers for the House come the midterms next year. And they had received really a big win in the House version, and that rolled back in the Senate version, but mostly so that the Senate could negotiate with the House and with the SALT caucus prior to the final text of the Senate bill coming out. And now we're starting to see some changes. It may not be $300 billion in value. It may be closer to $200 billion in value, but that's still being negotiated. That income threshold, the phase out, the indexing for inflation, all of that is on the negotiating table right now.
And as you said, we are hearing, getting reports right now that a lot of those SALT caucus members are on their way to the Treasury. New York Republican Nick Lalotta already calling Scott Bessent's latest offer, quote, insulting and disgusting. But that actually leads me to another question, Jennifer, and that is on the point of this Section 899, the so-called revenge tax, that the market was actually pretty worried about, as it could potentially really hamstring foreign investors from investing here in the U.S. Bessent today, in a post on X, seemed to suggest that they have struck a deal to remove or at least water down that provision.
That's right. This was, I think, very exciting news for the financial services industry, who's really concerned about 899 and how foreign investors may pull out of U.S. equities, which isn't good for our capital markets, which isn't good for our economy, right? But seeing that Secretary Bessent was able to make real progress with G7 and G20 countries on the issues of what they see as unfair taxes, extraterritorial taxes on U.S. companies. I think this is a good sign, not just for getting 899 out of the bill, but also going forward and making progress on some trade deals come this summer.
All right, we have to ask about really the elephant in the room, and that is what's going on with regards to some of these health care plans. There's been a lot of talk about the cuts to Medicaid, and of course, some would characterize them as not cuts at all. Do you think that as it stands right now, the provisions that we have in there to limit Medicaid coverage will actually survive this round of negotiations?
Well, that's being currently redrafted right now. And there may be a situation where the Senate, that made considerable changes from the House version, doubles back and goes back to the House version. And we'll have to see what those discussions with the parliamentarian result in. But we may see something closer to what the House passed. Now, as it relates to undocumented immigrants, the parliamentarian it made it pretty difficult in her ruling, it seems, for a redraft of that. But again, we'll have to see what they come out with in the next 24 hours.
All right, Jennifer, all eyes right now on Washington. Jennifer Flitton is head of U.S. government affairs over at Invesco, and we will keep an eye on the president, who is speaking at the White House, and bring you any headlines as we get them. Though when we come back after the break here, we are going to talk a little bit more about the economy with some big data points on tap for tomorrow, including the Fed's preferred inflation measure. Stick with us. This is Bloomberg.
Of course, if the tariffs are a one-off, you can look through them. And if they're just not going to materialize, then you have to watch both sides of the mandate. Ultimately, we have to watch both sides, and that's what I'm doing. And then the fall looks promising for a rate cut.
Everyone's talking about inflation, or maybe the lack thereof it. The PCE report, the Fed's favorite gauge of inflation, comes out tomorrow, as we're maybe potentially starting to see a dovish shift among some Fed members. That was San Francisco Fed President Mary Daly speaking earlier today, and we heard from Chicago Fed President Austin Goolsbee on CNBC earlier, saying that it's possible tariffs have modest impact on inflation. Yelena Shulyatyeva joins us right now, senior U.S. economist over at the Conference Board. And all the talk is why we haven't actually seen any real impact from the tariffs, meaningful impact, I should say.
It's too early.
Yeah.
It's just as simple as that. We have seen some pass-through in very particular certain categories of inflation, but it's just not broad enough to see it in the headline numbers, right? And on the other hand, goods prices are rising, right? But on the other hand, services pricings are weighing on overall pace of inflation. So for that reason, I will be watching tomorrow's report on personal income and consumption to see how much demand for services there is in the economy.
What's been the trend line on that? I mean, with regards to the consumption figures, so the personal spending, and I'm also curious as what the trend line has been on the income side as well.
So income has been really good, right? Just because inflation is decelerating. So inflation is falling, so that is helping real income. On the spending side, we have seen some slowdown. The numbers are still okay, right? It's still solid consumption, but it's slowing. So tomorrow's numbers may give us a hint of, what has been happening most recently.
We got some data this morning. We had a revision on GDP. Normally, we don't pay a whole lot of attention to third revisions, but it is significant to see the contraction that we had in the last quarter. And at the same time, we got weekly data on jobless claims that showed that continuing claims number continuing to creep higher. Does that mean anything?
The GDP number was very interesting this morning, and you're right. The third revision usually is not that big of a deal, but we saw a big revision in domestic purchases, right? The final demand to private domestic purchases. This is the number that Chair Powell cites all the time in his testimonies and press conferences. So that was revised down by 0.6%. That's a significant revision down. So, and that was driven by services consumption. So this is something that I'm really watching very closely. So what happens to discretionary spending, particularly in the services sector? So because that will define the trajectory of economic growth going into the second half of the year. So what consumers do about their discretionary purchases, not something that, we have to buy like food and gasoline. So in terms of the labor market, there's a lot of interesting data coming out right now. Continuing claims have been creeping higher, and insured unemployment rate has also increased. So it has been higher in June, and that may actually suggest that we will see an increase in overall unemployment rate next week.
But during the press conference that he had at the Fed meeting, Powell was asked about the labor market. He said something to the effect, I'm paraphrasing here, that basically, if you have a job, you're doing good because no one's really laying off. But he did say that if you don't have a job and you're looking, that maybe you are having some trouble. Is that something that you're seeing?
That is absolutely true. So that's what we see in our Conference Board Consumer Confidence Survey as well, that, consumers are telling us that it's very difficult to find a job once you lose one. That is also consistent with what we see in the payrolls data. So a lot of this unemployment increases that we have seen in recent months, since the unemployment rate troughed back in 2023, that has been driven by people having difficulty to find a job. Not so much by new layoffs, but those that were unfortunately, unfortunate to lose a job, they have difficulty to find one.
And in the latest Conference Board data on consumer sentiment, we saw significant deterioration, at least from the past report, if I remember correctly. But I am curious as to how quickly those sentiment numbers can change. So if people do feel like, okay, the tariffs aren't as bad, or maybe this tax bill actually does provide a boost to the economy, Do you see a big snapback in consumer sentiment, or is that something that kind of lingers?
It's been choppy recently, right? So we saw a big drop when tariffs were first announced. Then there was a rebound when the pause was in play. And now that it's a lot of uncertainty about where we end up in terms of the scope and the size of tariffs, it's still, declining. Consumers are very worried about tariffs. This is what they say in the write-ins to the survey. They're mostly concerned about tariffs and inflation.
So we have a market right now that seems to be convinced the Fed will cut rates this year twice and maybe 5 times by the September of 2026. The Fed has kind of made clear, at least for right now, it's probably not going to do anything in July. We might have to wait to September before we see anything. Between now and then, what are the data points that you're going to focus in most that will give you the most confidence about what the Fed will do?
Well, we have been a long time projecting a September and a December rate cut. So I think we kind of like now in line with the market. So all the markets are in line with us. I think, we are going to see 3 more jobs reports between now and the September meeting. So that will give us plenty of information about where the labor market is heading. We will also see 3 sets of inflation reports. So, and I think Chair Powell mentioned that June and July data will be very important in terms of them making a decision come fall.
You think that's going to be a hard decision?
I think it's going to be a really hard decision because I think despite the fact that we have seen a slowdown in inflation data until now, we can still see a pickup in inflation going into the summer, but the labor market may deteriorate.
All right, Yelena, always a pleasure to having you. Very smart. Yelena Shulyatyeva, senior U.S. economist over at the Conference Board, setting us up for what the market will have their eyes on over the next 24 hours. And then, of course, it includes that personal income and spending data point that comes out at 8:30 a.m. Washington time. And, of course, that includes the Fed's preferred gauge of inflation. At 10 a.m., we get another read on consumer sentiment with the latest University of Michigan numbers. And we get plenty of Fed speak this time from Beth Hammack and Lisa Cook, both scheduled to speak throughout the day tomorrow. And then after the bell tomorrow, something to keep an eye on, the Fed will release the results of its annual bank stress test. And remember, they did remodel the formula for that here. No one's expecting any major fireworks, but maybe some insights here into capital return from some of those big banks. We appreciate you joining us here on The Close. We'll be back tomorrow at the same time, same place, right here on Bloomberg.